Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. Welcome to our show that's for you, those who work so hard for your money, and you want your money to start working harder for you right now. You want that freedom and cash flow today, not 30 or 40 billion years from now, but right now, so you can live that life that you love with those that you love. But it's not just about getting rich, it's about creating a rich life, because as you're blessed financially, you can create a greater ripple effect through the lives of others. Thank you for tuning in today. Thank you for binging, sharing. Guys, thank you again. Like those of you that have gone and reached out to us, we had an amazing September where we have so many of you that we can do massive, massive stuff for. So really appreciate the big response we had of people, especially with that little birthday promotion where I was able to give a bonus meeting for those that signed up. Man, such an amazing thing. Thank you for reaching out to us. As a reminder, if you have questions, you can reach out to us at moneyripples.com.
Chris Miles was able to retire twice by the time he was 39 years old. But he's not content to just enjoy his own financial freedom and peace of mind. Chris wants you to have your own ripple effect so you can live free today. He's not the financial advisor you expected. He's the anti-financial advisor you deserve. He's jumping behind the mic right now, ready to make waves. Here's Chris Miles.
All right. The question that I tend to see from a lot of these people that had reached out over the last month, a lot of the concerns was about the stock market. Are we at the bottom? It seems like we are. Is it going to come back? That's a great question. Here, I'm going to say this simply. Is the bear market over? Is the stocks going to start coming back up again and rebounding? Even though this is late September, I'm recording this, the answer is no. I can guarantee that in my future, which is when you're watching this, the answer is going to be we're still in a bear market and we still got a lot of room to go. And that's the one question people are saying, wait a minute, but how low can it go? Are we pretty close to the bottom? If you're a financial advisor, you're already telling people, stay in it, keep dollar cost averaging because you're buying on sale. Well, great, buddy. Well, if it were really on sale, dollar cost averaging, should I have not listened to you when the market was hitting all-time highs in 2021? I should have stopped buying then, saved up all my money, or it hitting whatever low you claim it's going to be right now, huh? Nope, doesn't work. Dollar cost averaging is a joke. I taught that as a financial advisor. I can tell you that does not work. The reason they teach that to you is because they don't want you to second guess. And there's some truth to that. If you're the kind of person that actually tries to jump in to the market when it's hot, and then you jump out when it's not, you've already missed the boat and you're going to have bad timing. That's the one way that financial advisors are correct. The way that they're incorrect is this. Is that it's not always a good time to buy. In fact, the time to buy is when nobody wants to buy. And the time to get out of the market is when everybody's telling you it's still okay to buy. That's right now. I'm not claiming you guys should sell off anything. I'm not saying you should sell off your stock market, your stocks, your mutual funds, or anything of that nature. But I will say this. If you think it's going to go down lower, you might want to look at ways to preserve what you have, wait for it to go lower. Then if you want to get in, maybe do that. Now, many of you guys know I was a financial advisor before. What you may not know is I was also a stock trader. I actually taught and trained about 200 people how to trade stocks and options. Okay. I had done that myself. In fact, I was even doing that towards the end of my financial advisor days and even a little bit over when I was starting to teach people about getting out of the rat race. I was doing that for a few years. And it was interesting the things I learned, stock trading, that's different than what they teach you as a financial advisor. And so I'm going to come from that perspective because I've had a lot of you guys, especially those of you on Instagram or even on YouTube from time to time, you get some of these little trolls that say, Chris, I actually had somebody claim this. They said the S&P 500 is the safest, most diversified asset in the world. The world. Literally, quote for quote, safest, most diversified asset in the world, end quote. That's the most ignorant statement I've ever heard. I don't know what it is. Okay, that is one of the most ignorant things to ever say. First off, I didn't know this guy was the world authority. That's pretty impressive. Secondly, this person's coming off saying it's the most diversified and it's the safest. First off, there's so many safer assets than mutual funds. He was saying the S&P 500 to be exact. S&P 500 is not safe. It's not even conservative and definitely not low risk. And on top of that, it's not diversified. Yeah, they might say, 500 companies, but it's the same asset class. You want to look at diversifying your assets by other asset classes that are not in the stock market or affected by the stock market. Okay. So that was just ridiculous. Now I know most of you guys get this, but it's just the weird trolls that have nothing else to do with their time and like to put comments on this. But I want to address them specifically because I know there's a part of their voice that's also in your head because it's the mainstream, what mainstream says. And if you follow mainstream, you will lose. Mainstream sucks. Mainstream people are broke. Mainstream people don't become financially free. Mainstream people won't become financially independent by 2030 like you can be. No, this is not going to happen for these people ever. Okay. Never going to happen. They're full of BS and crap. Okay. So crap, so much BS. It's just brown. Okay. Totally brown. Okay. So I'm going to show you an article by Motley Fool here. Okay. So this is written by Sean Williams. Where will the bear market bottom? And so he talks about 2 valuation-based indicators offering a clear range. Okay, so this guy's going to say, is this the bottom? Now, understand, Motley Fool, if you're following any of these kind of places, we'll just take a look. Should be seeing some ads here. Oh, look, Stock Advisor, also a Motley Fool service. You should buy that because what do they want you to do? Buy stocks. If you ever want to know what these guys promote, just look at who's advertising on their thing, right? Notice latest stock picks. They want you in the stock market. Now, they might tell you that you can short stocks. But of course, this one's coming from, how do we know what the bottom is of this bear market? Because that's what everybody wants to know if they're trading is when's the bottom? When's the cheap money happening? So he uses 2 different valuations. First one was called a forward PE. PE is price to earnings ratio. Price of the stock is divided by the earnings per share, and they come up with a number, right? The lower the number, the better, the more undervalued it is. The higher the number, the more overvalued it is. Now, Sean Williams here, as he starts this thing off, before we talk about that 4 PE ratio, he talks about how right here, officially, we have no clue. So he's just saying, we have no clue where the bear market bottom is. Best honest answer that he's had. Okay. Now he's talking about, here's some calculations you can use. So here's the forward PE, right? Now the forward PE right here, he says that consistently, if you look for the bottom, it's between 13 and 14. That's where they find their bottom, right? So their claim is that, of course, PE ratio is high, has been high. It says currently, as of September 21st, 2022, it's a 15.9, higher than the 13 to 14. He would say, based on that, the bear market bottom, the S&P 500, which currently, as I'm recording this, is actually right now at 3647. Might be higher or lower, depending on when you're listening to this. 3647, it says it could be anywhere from about 3100 to 3300 on the upside. So what he's saying is really, even where it is now, that could still go down a little bit lower, right? And that means even from where I am at 3647, going down another 500 points is like losing another 15% after you've already lost over 20%. That means you're really losing a total about 35%, about a third of your money before you finally get a recovery. Remember, when the market goes down, it goes down pretty hard and fast, then recovers more slowly. It doesn't come back up hard and fast. It doesn't do a V shape. It's more like a weird check mark. Okay. Now, he did say that this is not always perfect. So he talks about the S&P 500 Shiller ratio, which right now shows a 28.9. Just use a little bit different valuation, right? Now, this one, the Shiller actually says that the bottom is supposed to be about 2,900 to 3,300. So again, on the big upside, 3,300, but this one could be as low as 2,900, meaning you lose about 40% of your total from the height of the beginning of 2022. So either of these valuations are saying, the market bottom is around 3,000, give or take. That's what they say. Now, using PE ratios, it's not a good indicator, okay? I actually used to put weight into that, but over time, I realized that wasn't the case. I used to use things like PEG ratios, where it's price divided by earnings divided by growth, 5-year growth estimates. Here's the problem. I just saw recently, I'm trying to remember who it was right now, but one of the financial pundits out there said, hey, well, market valuations are based on like this 50x multiplier because of lower interest rates. If interest rates keep increasing into this territory that they're going into right now, we have to reevaluate what valuations are actually becoming. So price to earnings, the problem with price to earnings, they usually take the past 12 months. They take the past and then they try to project a little bit of the future as well. But if because of higher interest rates, those future projected growth of those companies go down, that shifts and changes everything. That means the valuation. So even when they say that, that one PE ratio is like 13 to 14, well, remember that these things adjust along the way. And this author, Sean Williams, does acknowledge this in that article. He does say in here in Motley Fool, he says, no, it can adjust depending on what happens in the future. Duh. Yes, none of us can predict the future. One more reason why not to gamble your money into the stock market. And it's amazing how many of you get so upset when I say gamble. They're like, it's not gambling. It's not like going to Vegas. Over time, it goes up. Yeah, you're right. Over a 20-year period, the market has always been higher. There have been some 15-year periods, not so much, but they always say 20-year periods, at least they've gone higher. Yeah, we get that. But many of you don't want to wait 20 plus years to make your money back, do you? Or just get a little bit of growth. You need a massive amount of growth now, tomorrow, and next year, and the year after that, and the year after that, to even have hope of financial freedom. And they don't even realize that these people that are telling you, oh, no, the market's safe. It's a great place to be. It always goes up. They don't realize that they're trapping you in a place where you're not going to make enough. Because the truth is, you will not make enough money in the stock market. It has not done that kind of return. So, answering to many of you guys, and especially those that are the trolls, the truth is that the market isn't a safe place to be. It isn't very diversified. That's why you can lose money in it. If it were diversified, you wouldn't lose money. If it were diversified, truly diversified, you would have some up, some down, but you would overall still make some money. That's not the case here. You can lose a lot of your money. And some of you have already lost too much of your money and you're holding on because you don't want to lose more. I'm here to tell you, you hold on, you're not just going to lose more as the bear market goes down farther, but you're also going to lose in the sense that you've lost time, your most precious commodity, when that money could be doing something better in these other alternative investments that we talk about. And yeah, someone will say real estate investing is risky. That's because you're an idiot. Sorry. If you believe real estate investing is risky, either one, you're ignorant, or two, it's because you don't want to look into it. Or maybe you're just a gambler anyways, and you do dumb stuff. So either you're ignorant, you just don't know that there's better options, or two, you just don't want to know because you got some sort of self-interest in it. Maybe you're a financial advisor posing to be someone who thinks that the stock market's the way to go because you want their money to go in with you. This is why we don't offer a fund ourselves. This is why we don't sell any investments ourselves. That very purpose, to not be swayed by our own self-interest. Because people got it, whether they like to admit it or not, they're self-interest. I'm self-interested to teach you this stuff. One, because I know you get your results, but two, when you get better results, that makes us look better. And what does that do? It gets more social proof that more people want to do this and over, because the truth shall set you free. And the problem is the truth is not being taught, not by the majority. The majority is teaching you how to remain broke your entire life, not how to do it differently. Let me show you what I see in the market, okay? Those are the PE ratios, but the ratios are dumb. They can be flexed. This is what I see with the S&P 500, right? Now, I have this chart going back from the Great Depression, really going back from the 1930s. Notice I have this little line here. This is what's called a trend line. Trend line, what happens is that as time goes on, the market does go up and it tends to bounce off of certain points. And there's different things called support lines, resistance. See right here, there's like these two tops, they hit about the same point. Yeah, that's called resistance. When they hit that same point, like right around 1500 on the S&P, that's a point where it becomes like this little top. But it also becomes a bottom eventually where it doesn't go below that down the road. So there's tops and these bottoms. Like imagine like these invisible floors as you're going up and climbing up through a building, right? Well, here's where we are now. Now we've come down. This is as of September 27th. We're about 36.47 is where the market closed. These might be more or less depending on when you're watching this. Now, notice that we're pretty far above this trend line. In fact, the trend line right now is about 1700. So that means for it to come back to order. Now, notice that over the years, it tends to bounce on it. Now, it might take decades before it bounces. In the 70s, it bounced along it like a little bouncy ball, just like it was in the sing-alongs back in the 1970s. But then it took off, even Y2K, look how high it was. And then even after the Great Recession, and bam, hits the floor right there in the Great Recession. Right about 2009, March 2009 was a low, or it came back and bounced up. This is also when my wife, Adise, had actually bought mutual funds right about that same time, making lots more money in the market because she bought at the right time. Some of you might have done this. And then it took off and it's been overvalued ever since. And then that's normal. It's normal for it to want to correct and pull back. Now, it may not pull back all the way, right? It might pull back part of the way, just like it has done in other times where you see it pull back and then go up again. That could happen. If it doesn't pull back all the way, what can often happen is like what you see here in the 1960s. Look here, right around 1965, it hits up, right around just about 100, right? Notice it doesn't get much over 100 the entire time. It just stays right around there. And even into the 70s. Look at this. It wasn't until we got into the 1980s and then finally, and even then, it wasn't until really 82 you started to see it really take off. Took it really 17 years before we got past that little height that it hit right around 1965, right? So understand that sometimes you can get stuck, just like people in the 60s and 70s did before things really took off. This is why the stock market wasn't as popular during that time, because what kind of money would you make there? You make more in a CD that used to be higher interest rates back then. Anyways, long story short, this could pull back. Now, I don't think it'll pull back all the way to 1700, because the truth is the line just keeps going up. I think it's going to meet in the middle. If it does go all the way down, it could go down as low as 2000. So where they're predicting 2900, 3000 at the bottom, my prediction is I think it could go as low as 2000. It may not. It may continue to bounce up before it comes down and there's a harder crash later. That should concern you, because that trend line still doesn't even hit to where it should be. What we're talking about here till 2034. So right where we are now, the trend line would be really 12 years from now where it should be, where it is today, right? That's after you already lost over 20% of your money. So I think you could possibly lose over 50% total from the height that we saw at the beginning of 2022. That should concern you. Okay, so that's not the only thing that should concern you, right? The other thing that should concern you, of course, is what's happening. So right now, the Feds, it came out in the last meeting here in September. The Feds actually announced, as part of the stuff that's been glossed over by many investors or even by the media, is that Jerome Powell, the Fed president, said, and I'm not quoting exactly, I'm paraphrasing. He said that he wants federal funds rate, which is now at 3.25%, to surpass whatever the current inflation levels are. So right now, the inflation level is showing 8.3% that they're reporting. We know it's higher, but they're reporting 8.3%. He's at 3.25. He's 5% below where current inflation is. So what he's saying is he's going to aggressively raise these interest rates, until at least it surpasses. Now, maybe inflation starts coming down gradually. They might meet in the middle somewhere, but it's very possible he could be raising rates 2, 3, 4% more than what they are currently. That should concern you, because that's already making money expensive, makes it harder, contracts the economy. And he even admitted himself, saying, look forward to the average American and some small businesses pretty much being in pain, suffering, right? They already are acknowledging that. Now, I know it's going to be much worse than that, because if they're acknowledging that, there's a problem. They're already aggressively going for it. And they tend to swing the pendulum too far to where they overdo it. And then it throws us into a recession, possibly a depression. And then they try to come back and undo it and lower interest rates again to see if they can get things spurred up again. But it's happened, right? There's a lag effect, and they're trying to watch it. But the truth is they swing the pendulum too far. This is going to affect most everybody. If you've got money in the market, you should be concerned, because in a bear market, they hate this. Now, it's not just the US. We also have other countries having issues too. Globally, we're actually looking pretty nice right now. The dollar is stronger than it's ever been. Well, that's not good news for US, because that means that often things are going to start outsourcing outside of the US. This means we start importing a lot more than we export, because why do we want to pay top dollar, no pun intended, for stuff that's more expensive? So other countries, now it might help other countries, but don't count on it. There is so much turmoil going on, especially in Europe and everywhere else. There's so much going on that ripple effect will be creating ripple effects across each other to where we're going to have this major contraction right now. I really believe economically, this is going to be the worst time for the average American, but the best time for those that are educated, those that actually are looking for the opportunities. I'll say this: many people are afraid to hold cash because of inflation. I think this is the best time to have cash. Cash right now is your friend, especially if you can buy real assets that are benefited by inflation. Guess what? We talk about those. We talk about real estate. We talk about oil and gas. A lot of these things are being benefited. By the way, oil and gas, mark my word, after November, prices will come back up because they got their votes that they wanted. So then prices are going to come soaring back up, because the truth is they're dipping in our reserves like crazy. Our US reserves are getting low. It's not a good thing. So we're going to start seeing prices going back up again, at least for the oil. We're going to start seeing the stock market tank. It's not going to be pretty, guys. The thing you got to do is make sure you're not the casualty here. You don't become the victim to this, because it's not for you to become the victim, right? This is for you to come out triumphant, victorious. And you can do that if you just start doing the opposite of what everybody in the media tells you. I hate to say it, but we're like a broken record, aren't we? Are we saying it again and again? I'm saying this because I'm truly emphasizing that you need to question everything. And even though I know there's some faithful listeners here, many of you have been listening to my advice, you've been listening to my predictions, watching them come true, and then doing nothing about it. The ones that I am really happy about are those that say, you know what? I could see what you're saying. You're right. I took action and man, it saved me a lot of money. And I have had those people too that say like, I would have lost over $100,000 or $200,000 had I kept my money in the market. Now, I'm not saying again, you guys sell. I'm not legally making any recommendations because the truth is that you might be doing different stuff. I actually talked to somebody today that says, hey, I've actually been shorting the market, meaning he's selling at the high point and then you buy at a lower point. So you do it in reverse order. You do, I know it seems weird, but you can actually bet on the downswings, make money on the downswings of the market. He's been doing that, making bank the last little while. I said, great, good job. Way to go. Good, keep it up. If you want to keep it up, don't count on it for financial freedom. But hey, if he's going to take advantage of it, like using an index that actually goes up when the markets go down, he's doing great. And so, there's ways to do it, right? But for the most part, you're not going to see people doing that kind of thing. Even the people that tell me S&P 500 is the best thing, they're not trading the S&P 500. They're not trading stocks. They're putting their money in mutual funds, letting it sit there. And they're saying, you know what? I'm just going to hold on. In fact, if I turn a blind eye, it's going to be good. This is the same thing that husbands do in their marriages, isn't it? Sorry, wives. I don't mean to discriminate. You might be doing it too. But it's not uncommon for husbands to turn a blind eye to what's going on in the family, right? They're saying, like, I'm happy, I'm good. And then their spouse leaves them. It could be the same thing with kids. You could turn a blind eye to your kids. Don't worry about them. Hopefully it'll all turn out. And then they wonder why their kids end up screwed up. Guys, you don't think that happens with money too? Turn a blind eye to it. I don't watch it. I just want to wait. Tell me when it comes back up. I don't want to watch. No, don't let me watch it. It's a scary movie. No, I can't. Guys, this is how you lose money. Happens every time. And most people will end up selling at the very market bottom. So don't do what the majority of people do. The dumb money right now haven't left the market. Here's another key factor. Here's why I know it's going to go much lower. The big money, the bigger investors, the hedge funds, and the people that have portfolios, they've already started to sell off their stocks. They already know what's coming. The retail investors, as of now, and here in late September, have not sold off anything. So the dumb money has already gone in. I mentioned that last year in 2021, the dumb money was going into crypto, it was going into the stock market, and we've seen the effects of it as it's gone down. But the dumb money hasn't sold yet. Just like in crypto, most people haven't sold a lot of their crypto yet. The people that have already missed out are holding on their crypto, hoping, well, maybe it'll come back. Like I sold mine in March. It was at a height when I realized it was being price controlled. I sold my crypto. I had some just to play with, just to gamble with, not to make money off of, really. But I made some money. I made some pretty good money on that deal. But I also got out when people were saying, go in. People aren't really saying get out of the market right now. They're saying hold on. So the majority of Americans, the retail investors, they call it, have not pulled their money out yet. That's why there's so much more room to go on the stock market. Question is, are you going to be the person that finally says, after all the normal money, the dumb money's come out, and then saying, I'm going to sell now. And then you got this little bit left to say, Chris, now what do we do with it? You going to do that? Or are you going to say, maybe I can capitalize on what's going on now. Maybe I can just move my money and just protect it. Maybe I want to keep it in the market, or maybe I want to keep it in the same place. Maybe I don't do real estate investing. Maybe I just keep it there. But maybe I move it to like a money market or somewhere that's safe and certain. So at least I don't lose money while it goes down. And if it hits this really great low, maybe it bounces on that trend line. Maybe it does. The SP goes down to 2,000. I can tell you, I might be putting money in to the market. Again, not enough to try to make a lot of money on, but enough to say I can gamble this and I don't care, right? I probably would, because I, again, watch those trends and I don't mind doing that. Just like I did with Bitcoin when it got down below 6,000, I bought after it crashed from its 20,000 high and then sold when it was up around 50,000. There you go. Made money off that. So same thing with the market. I might do it too. I'm not giving recommendations, but the people that actually act now before everybody else says to do something are the people that win. When you wait for everybody else, when you wait for the masses to do it, that's when you take the M off the masses, and that's what you become. Right? That's where you look like one. You look like the masses, right? You don't want to do that. You don't want to get caught with your pants down. You want to be the person that actually gets out early and people will look back and say, oh, that was awesome. Like, I can't believe you did that. How'd you know? Because I listen to good, smart people. I'm not saying I won't be wrong. I won't say that I'm Nostradamus. In fact, I've made many wrong predictions before. But I do know when the market feels crazy and when there's more room to go, it generally does. So take it for what it's worth. You can figure out whatever you're going to do with this kind of opinion piece that I'm giving here. But the choice is still up to you. What are you going to do about it? Could you actually be using this money in better places? Could you actually be using this money to help you create cash flow and passive income now versus waiting because you don't want to lose 20% of your money because you're just holding on, hoping that it'll come back to where it was. Although history says that even when it does finally hit the bottom, which could be at least a year or so from now, when it finally hits the bottom and bounces up, you finally say, great, now I just got to wait. And then it bounces up slowly. And then you're waiting 5+ years before you finally say, got my money back. The problem is you did not get your time back. You lost those 5 years. You could have been doubling or doing better than that on your money. That's the thing you lose out on. That's what time does to you. Guys, if you have any questions, reach out to us, moneyripples.com. But is the bear market over? Heck no. It's got plenty of room to go. What are you going to do about it? That choice is yours. Make it a great and prosperous week.